Welcome to this explainer. Right now, beneath the surface of the global economy, a really profound structural realignment is underway. Imagine the global financial system not as a static, unmoving machine, but as a series of massive tectonic plates. For decades, those plates have been firmly locked in place by the undeniable weight of a single currency. But today, well, the ground is shifting. In this explainer, we're going to pull back the curtain and explore exactly how and why the very architecture of global money is changing.
Take a look at this number. At the end of 2024, the US dollar accounted for just 58% of global foreign exchange reserves. Now, to put that into perspective, a decade earlier, that share was sitting at 65%. So what we're looking at here is a slow, quiet, but absolutely undeniable erosion of trust. We are literally witnessing nations deliberately diversifying their national savings away from the greenback. And look, it's not just geopolitical commentators saying this. Major financial institutions are officially sounding the alarm. The global head of FX research at Deutsche Bank recently stated that we are entering uncharted territory and that the unchallenged supremacy of traditional U.S. assets is facing systemic pressure. When the people who analyze global wealth for a living tell you the map is being redrawn, it's definitely time to pay close attention.
To truly grasp this paradigm shift, let's move into our first core area, the shifting bedrock.
We really need to look at the silent return of the ultimate hard asset. According to Bloomberg, for the first time since data tracking began back in the late 1990s, global central banks actually hold more value in gold than they do in U.S. treasuries. Let that sink in for a second. Sovereign nations are actively choosing a physical block of metal over the world's premier sovereign debt. Why? Well, it's simple. Gold carries zero counterparty risk and zero political risk. It can't be frozen with a keystroke, and its value doesn't depend on a foreign government's fiscal policy.
This pivot toward gold isn't happening in a vacuum, which brings us to our next major shift, fracturing the petrodollar system.
Let's step back and trace how we actually got here. In 1974, the Petrodollar Agreement cemented the US dollar as the exclusive currency for global oil trade. That created a constant mechanical demand for dollars worldwide. But fast forward to 2022, the weaponization of the dollar system through sanctions, specifically freezing roughly $250 billion in Russian assets, sent an absolute shockwave through non-aligned nations. The implicit message was suddenly very clear. Your dollar reserves are only yours as long as your politics align with Washington. And by 2026, we're seeing the physical manifestation of this. Iran is now conditioning safe tanker passage through the critical Strait of Hormuz on oil settlements being paid in Chinese yuan.
So the crucial takeaway here is that this is no longer just some academic theory. Today, approximately 13 million barrels of sanctioned oil per day are already being traded entirely outside of the US dollar rails. That's roughly 14% of the global daily oil supply. A parallel financial market has been quietly constructed, and it is fully operational right now. Deutsche Bank analytically describes these exact geopolitical developments as a perfect storm for the petrodollar. The control of critical maritime choke points is forcing energy importers to find alternative ways to settle their bills. And it's rapidly accelerating the use of the Chinese yuan in global energy settlements. What we're watching are the very beginnings of the Petroyuan. In response to all these vulnerabilities, the BRICS alliance is making their move. Let's look at building the new architecture. They aren't just complaining about the current system, they're engineering a new one. Enter the unit. Launched as a prototype pilot in late 2025, the unit is a digital trade currency designed specifically for cross-border settlement among BRICS economies. Now, I want to be super clear here. This is not some volatile cryptocurrency like Bitcoin, and it is absolutely not meant to replace domestic currencies like the Brazilian real or the Indian rupee. It's a tangible, institutional settlement tool custom-built to bypass Western correspondent banking infrastructure entirely. And the mechanics of this are really fascinating. If you break down this basket, 40% of its value is securely anchored by physical gold, held in sovereign vaults. The remaining 60% is split equally among the fiat currencies of the 5 founding BRICS nations. It's an incredibly clever, decentralized mechanism. The physical gold acts as a massive stabilizer, essentially smoothing out the inherent volatility of those emerging market currencies. But of course, to back a system like this, you need hard assets. And the BRICS nations have been aggressively preparing for this exact moment. Their combined gold reserves now exceed 6,000 tons. Furthermore, they control roughly 50% of global gold production.
Through the unit, they are literally transforming gold from a passive relic sitting in a dark vault into an active, dynamic mechanism for daily international trade. And if you think this is just a pipe dream, think again. Top analysts at JP Morgan have publicly acknowledged that this framework represents a highly credible, thoroughly developed blueprint. It's a pragmatic, grounded system designed specifically to insulate global trade from U.S. monetary policy and the looming threat of sanctions. However, a new currency basket is only half the equation. You need the plumbing to match. Let's transition to the digital rails. Consider the stark contrast in technological infrastructure here. The legacy system relies heavily on the SWIFT messaging network and US dollar intermediation. That means most cross-border transactions have to physically bounce through a US bank, leaving them completely vulnerable to oversight and unilateral sanctions. The proposed BRICS system essentially rips out that legacy plumbing. They're utilizing interoperable central bank digital currencies running on peer-to-peer distributed ledgers that are governed entirely by neutral smart contracts. So how does this architecture function in the real world? While pushed strongly by India's central bank for the 2026 BRICS summit agenda, the system aims to seamlessly link up various national digital currencies. Through advanced cross-chain protocols, they can instantly reconcile different national ledgers. By using something called atomic swaps, trades execute instantly without any counterparty risk. This is a massive leap. It reduces settlement times from days down to literally seconds, while dramatically slashing the transaction costs. But you know, any massive financial transition is going to face practical hurdles. A major challenge in trading in local currencies is the accumulation of unusable foreign cash. For instance, if India buys a massive amount of Russian oil in rupees, Russia might end up with billions of rupees it simply doesn't need. To solve this, the bloc is actively testing sophisticated bilateral currency swap mechanisms. Think of these as pressure release valves that automatically balance trade ledgers on a weekly or monthly basis. Which leads us to our final overarching theme, a multipolar financial future. Despite these truly monumental shifts, it is absolutely vital to maintain an objective perspective on the timeline here. As a recent analysis by the Atlantic Council rightly points out, the US dollar still possesses deep, unparalleled liquidity. It has massive network effects built up over nearly a century of dominance. The legal frameworks, the sheer scale of the US Treasury market, all of this ensures the dollar is not going to just collapse overnight. Its role as the primary global reserve currency remains secure in the near to medium term. And that brings us to the ultimate takeaway of this analysis. The goal of the BRICS financial infrastructure isn't a dramatic overnight disengagement from dollar-based markets. They aren't just setting their dollars on fire. The goal is diversification. It's about creating optionality. We are witnessing a slow, deliberate, and highly structured realignment. It's a tectonic shift where the dollar's historical exorbitant privilege slowly but inevitably gives way to a truly multipolar reality. As we wrap up this explainer, it leaves us with a fascinating reality to ponder. This evolution challenges us to fundamentally redefine our understanding of systemic trust. As the very plumbing of global finance becomes increasingly weaponized, we have to ask ourselves, how long can a purely debt-dependent system endure against a rapidly organizing, gold-backed alternative? Will the future of your money be defined by the geopolitical alliances your country builds, or by the hard physical assets it holds? I'll leave you to think about that. Thanks for joining me on this explainer.